Welcome, welcome, everyone. I am so glad you are here today. We have a really special guest, two guests, actually. They are a team working together, and I will introduce them in a few minutes. We are the Nest Egg Builder, and the Nest Egg Builder empowers people to build their wealth consistently by investing in commercial real estate. And we work with several people that we are so proud to have them as part of our team. So I'm reading this really great book, and I'll tell you about that at the end. But this article is Never Take Your Eyes Off Money. The main reason most people aren't rich is that they refuse to focus on earning, investing, and saving money. Society has brainwashed them to believe that money is a dirty thing, a necessary evil that nice people don't discuss in mixed company. Most people avoid the subject altogether and think about money only when forced to. Never make this mistake. Money is one of the most important aspects of life, and without it, we'll experience stress and struggle. The key is to focus on it. Once you identify what you want to do as a career, focus on earning, investing, and saving money as you pursue it. Enjoying and maybe even loving your work should come first. Money won't create the emotional fulfillment that satisfying work offers, and it's not supposed to. Money is powerful, but it's still only a medium of exchange. It cannot give you the deep sense of fulfillment of doing a job you love. The secret is to take as much time as you need to find what you love to do and then focus on getting rich doing it. Fulfilling work without wealth equals stress, worry, and sleepless nights. You need both to live a good goal. The way you keep your eyes on money is to provide as much quality service possible as many people as you can, for as many people as you can, and for as long as you can. The next step is to spend your money wisely. Live below your means and study how to invest and save. But be aware, living beyond your means believing that the gravy train will never end, and it will end. It always does. Good fortune could suddenly turn into misfortune. Be smart, be frugal, and always know your financial position. If you follow this advice, you'll live a life in abundance. And this is by Steve Seibel, and his book is Secrets Self-Made Millionaires Teach Their Kids. And most of us are always kids. He has a book that he's put out that is 365 lessons. If you're interested in buying that book to teach your kids, no matter how old they are, the parent is to read the chapter to the child so that everybody learns. Oh, I still need my glasses though. So I'm really excited today to present Harlan, who just stood up, who's sitting in an airport changing planes, and we're very fortunate to have him here because of that. So Harlan Accola has been in the mortgage industry for more than 20 years and is now the National Reverse Mortgage Director for Movement Mortgage. He is widely recognized as an authority on revenue mortgage loans and retirement finance issues. The most rewarding part of his career has been helping homeowners and home buyers age 62 and older to realize the benefits of reverse mortgage and achieve better retirements. Yes, we like that. Harlan is deeply committed to improving the way retirement is done in this country. A skillful, highly sought-after speaker, Harlan delivers presentations that will give you a very different perspective. He often asks his clients and professional partners, if what you thought you knew about mortgages and financial planning was wrong, when would you want us to tell you? When Harlan isn't helping his clients and trusted professionals with home equity retirement strategy, he enjoys serving as a wedding officiant. I hope I said that word right. Traveling, spending time with his family. Harlan and his wife Brenda have been married for over 30 years, currently reside in Minnesota. Ooh, right near you, Patty. They have 4 adult sons. Each are now married and have 5 grandchildren. And Harlan just got back from Ireland. Not Ireland,
Iceland. Just
Iceland. That
one
other
letter.
I in Europe. Not
Yes.
in Europe, on his own island, if they call it that. So welcome, Harlan, and welcome, Michael.
Well, thank you, Peggy. Appreciate the intro, and I'm going to have them rewrite that to make it a little bit shorter because otherwise you're going to expect a lot out of me. It sounds pretty good. Um, Michael, I'm the one that does the talking and the educating. I used to do the loans. I don't anymore because I am responsible primarily for training and managing our division here of about 30 people at Movement Mortgage. Um, and Michael is the guy on the West Coast that actually does the work. I do the talking, he does the work. And Michael was always going to be a financial planner, and he really didn't realize it, but that's what it came around to. Is just that he's doing it from the perspective of liability management in conjunction with asset management. And Michael, before I start talking, maybe you can just mention a few other things. But Michael is a fun guy that actually does the work and goes through the whole process of the loan process and takes all of the irritation from the clients when they have to send in one more piece of paper.
Yeah, thanks for that, Harlan. Yeah, so Harlan and I met back in 2014, and me, like just about everybody I speak with, you hear the words reverse mortgage, and people want to run the other way. So I was very skeptical when I first met Harlan, and here, 10 years later, this is all I'm choosing to do. I believe in it so much. It's only reason I don't have my own reverse mortgage yet is that I can't get one. I'm only in my mid 50s, so I got a few years left to go, but yeah, Harlan's a wealth of knowledge, and I've been in the mortgage industry since the mid '90s, and this is how I'm choosing to spend the fourth quarter of my career just doing this product. I don't even do any other types of loans anymore. Just do reverse mortgage planning because it's such a huge need. So look forward to talking with you all, and Harlan, I'm going to give you the floor.
Well, thank you, Michael. And I really love what you read, Peggy, because the vast majority of people that I deal with, especially in retirement planning and in the retirement area, um, they don't spend much time looking at it and planning for it. And one lady told me, I'd rather talk about sex than money. And I thought, wow, that's getting pretty personal. And when you said it's something that is, private and it's dirty and, you don't talk about it outside of, hushed circles, it's amazing how many people don't pay attention to it. And then they end up and they're retired, and half the people out there don't have enough money to last them for 3 or 4 years. It's scary. And unfortunately, some of us that have money are going to be paying to take care of those people who never plan. So we certainly want to encourage everybody. And I'm preaching to the choir. All of you people are investing and planning, or you wouldn't be on this call. But it really is important. I talked to somebody once, and he said, I've had money and I haven't had money, and it's really easy to have money. And that same guy told me this. He said, money isn't everything, but it is reasonably close to oxygen. And that's kind of a joke, but think about it. How far do you get without oxygen? Not very far. You can make it maybe a few minutes without oxygen. Think about, I started out my day at 5:30 buying some coffee this morning at Starbucks, or $5 or whatever you call it. So the issue is that we need money for just about everything. Getting on an airplane and putting gas in our car and buying some food, whatever. And so And some people say, well, I've got enough. Well, if you got enough, make some more because then you can help people who don't have any. So I really appreciate the way you started the show. I was listening to an article or watching a video actually, listening to this video, and it was called Asset Blindness when it was talking about home equity values. If you look at just primary residence, forget about all other investment real estate for a minute that a lot of you work with. Just think about primary residence and think about just people over 62, people in my age group, and some of yours that have gray hair or no hair that are approaching that or getting close to that age. Just us are sitting on $12 trillion worth of equity, 12 trillion with a T. That's more money than people have in IRAs. And it's very evenly distributed, unlike IRAs, which are much more skewed to the top 30% of the population. So there's a lot of wealth, and people are blind to that wealth. I just talked to a lady in Long Island, New York, in her 80s, and she thought she was broke, and she thought she was going to have to sell her house. Her husband had died, hadn't done a great job of planning, and used a lot of money in the care that he had to go through. And here she didn't have enough money to pay her taxes. She didn't have enough money to really even cover the cost of the repairs on her roof. And here she's sitting in a $5 million house. All of her other money is gone. And I said, we can give you over $2 million in a reverse mortgage, and you don't have to give us your house. It's just a loan that accrues interest like any other loan, and you can pay it or you don't have to pay it. And when you pass away, then it gets paid with the value of the house. And her kids were on the call with me, and they said, Mom would love that because we're not waiting for her money, and we just want her to enjoy life, and she doesn't want to move. Everybody tells her she should sell her house. She doesn't want to move. She loves her neighbors. She loves her house. She wants to stay there. So not only did she start taking money out of the house, she also started investing again because that was always her hobby. And her husband never really let her do it because he was kind of domineering and thought he knew what he was doing, which he really didn't. That's another story. But she actually not only started using the money in her house to live and fix her house and put that money together, but when it comes to asset blindness, I thought she was asset blind. She didn't realize she was a multimillionaire. She was broke as far as money in her account, but she had a $5 million house that was paid off. Most of us don't think about using that money. And that is a paradigm shift that everybody has to make. Now, some of you, I recognize that we've talked to before, so a little bit of this will be review, but you may have seen this chart before. And that is, or this little graphic. And it's important that I show this because this is where the paradigm shift really comes in. When you take a look at, and let me get just switch this over to share the right spot here. Here we go. So there's 3 buckets of wealth. Everybody who owns a home.
Hey, Harlan, we're not seeing it, but.
Yeah, that didn't come up there. Let me do that again.
Let's see if I have something to do with that.
Well, I stopped the share there.
No, it worked before.
Yeah, it worked perfectly before. It was there. Let me see. Okay.
I just switched our view, see if that makes a difference.
Okay, let me give that a try. Well, that is
weird.
odd. Okay. Well, I will. I don't have a lot of it that I'm going to show. I'm going to do more talking and answering questions, but I'll give that a try a couple of more times to make sure that I get that done, and bring that up accordingly. I'll just try it one more time.
There you go. Third time's a charm.
Perfect.
I put it up there, Harlan. Sorry.
Michael took care of it for me. Thank you very much.
Michael, can you go to full screen at the bottom? Looks like
you can go to slideshow, Michael, too, and just hit slideshow start on the top of the. There we go. Perfect. So everybody has 3 buckets of wealth who owns a home. Bucket 1 is your wages, your commissions, your income, your pensions, all of the money coming in from rental real estate and so on, which is kind of partly bucket one and bucket two, but that's your monthly income. Bucket two is all your investments, 401k, stocks, bonds, liquid things, as well as some of the real estate that is depending upon if that's part of bucket two or bucket three. Bucket three is all of your real estate equity, which is your home as well. A lot of people don't count their home. They count their investment real estate or their REITs or any of the other money, but they don't realize the other part of it. So when you're in the younger years, the top wallet, 18 to 62 years old, on a pre-retirement wallet, all the money's going up there. Most of it is evaporating right off the top. You're spending it on food and clothes and cars and kids, something called the cost of living. I saw a sign outside a church a long time ago. It said, the cost of living is high, but it's still extremely popular. Well, it just costs money to live. We talked about oxygen. So you try to save some money along with what you're spending that's evaporating right off the top. And that goes into bucket two, your savings, your investments, the things that Peggy was reading about. But what you are forced to do is send money to the equity bucket. You have to make your house payments. You have to make your real estate payments on any investments that you have. And that all goes into bucket three. Now, you get to live in that investment. That's kind of a big deal because that's a great value that you get to live in that investment. So what a lot of people don't realize is you're piling money into bucket three. It's usually the biggest expense. It's usually about 30% of the average person's income is being poured into bucket three, about 30%, a lot of it. And you're only putting in, most people only put in 5%. Wealthier people put in maybe 10 or 20% of their income into bucket two. Well, when you get to be 62 or older and you start thinking about retirement, bucket one slows down. You don't get as much money in your wages, your commissions. Maybe you sold your business or gave it to your kids or the kids took it over or whatever. So you go to bucket two and you take money out of your IRAs. All our reverse mortgages is very simple. It is simply money that is taken out of bucket three. You put in hundreds of thousands of dollars over the years into bucket three. For 40 years, you've been putting money into bucket three. Now you're just pulling money back out, and we allow you to use some of the money, 30 to 50% typically of the value of your house, depending upon your age, that you can pull out and use. If you currently have a mortgage, pay it off with a reverse mortgage because now your payments are optional. As soon as I got to be 62, 2 years ago in April, I immediately, as soon as I qualified, did my reverse mortgage. I didn't see any good reason not to. I had been planning for it for years. So I turned my regular mortgage, about $400,000 that I had to make $3,000 a month payments on, I turned it into an optional payment mortgage. Now I don't make mortgage payments anymore, so I can invest more money into bucket two because I'm still working and I can afford to make mortgage payments, but I don't want to. The whole crux of this understanding and all the research that I've been done is very simple. The more money that you keep in bucket three and the less money that you have in bucket two or bucket one to give you income, Social Security, real estate investments, and so on, and the more money you use to pay off your house, the less money you have to make income off from, and the less productive, the less efficient your retirement is going to be. There's no question about it. It's not an opinion. A lot of people say, well, you got a right to your opinion. I want to have my house paid off. It's not a matter of opinion. It's a matter of math. Can some people make it to the end without a reverse mortgage? Sure, you can. You can make it to the end. You might have to go back to work. You might deplete more of bucket two. So it's possible to do it without a reverse mortgage. I have to be in San Diego tomorrow morning. So I can bike there, take me a number of days, a number of weeks, the way I bike. I can drive a car there. That'll take me probably a couple of days of driving. Or I can pick up an airplane here in Minneapolis in a couple of hours and get there in 3 hours. What's the most efficient way to do it? Well, the most efficient way to do it, if I want to be there tomorrow morning, and the only way to do it is to get on an airplane. So when you when you incorporate bucket three, any real estate, half of my portfolio is in real estate, not just my house, but in other real estate. In fact, I've got a sale coming out on one of my active real estate investments. I'd like to turn into a passive real estate investment that I'm going to talk to Peggy about because I've got some money coming out of a 10-year investment that I've actively managed that I didn't like to actively manage anymore because I'm busy in other things. But the fact is the more money that you have in bucket three in your house and the less money you put into bucket two and other investments, the better your retirement is going to be, the better your net worth is going to be, the better your cash flow is going to be. A house is one of the biggest cash flow suckers in retirement. It is the biggest expense in retirement unless you're really wealthy. And if you're really wealthy, your biggest expense is taxes, and we can help with that too. So it is incredibly important to understand that lazy money is no better than lazy people. Lazy people don't get paid anything. I drove by a McDonald's today in Marshfield, Wisconsin, which is not exactly a high dollar area. It's 20,000 population. Starting at McDonald's is $14 an hour. I don't even know what minimum wage is anymore, but it's somewhere, I guess it's $7, but anywhere is 14, 15, 20, $30 an hour. It requires that cash flow. So lazy people that don't go to work, even at McDonald's, do not make any money. And the fact is that money that doesn't go to work, that's sitting in bucket 3 doing nothing, is a drag on everybody's retirement portfolio. It's absolute. So if I would have paid off my house, which is worth about $1 million, if I would have paid that house off, I'd have $400,000 less to invest in bucket 2. And I can invest in other real estate ventures. I can invest in oil and gas partnerships, whatever is something that makes sense overall. And I've always tended toward real estate. I love real estate because you can touch and feel it, and it's real estate. And it's something that you know exactly what's going on. And the more you delve into it, the more you understand about it. So the fact is that it's very important to understand that you're better off putting more money into bucket 2 instead of putting it into bucket 3. Now, emotionally, traditionally, guess what everybody wants to do? They want to pay off their house. They want to put as much money as they can into bucket 3 until they paid it all off, and they can proudly go around saying, I've got my house paid off, it's free and clear. Great. You don't have an investment real estate portfolio. You don't have very much money in your IRA, but you got your house paid off. Hallelujah. Can you eat the screen doors? Can you eat the foundation? No, it's worthless to you because you're not using any of that money. It's sitting there, and the only thing you can do is give it away to your kids when you die. Well, here's something that I want to talk to you and I'm going to open it up for questions here real quickly before I go into some other things. When you talk about an inheritance, many people say, I want to give my house to my kids. That's just now. My parents gave me part of their house or whatever. I just want to give my house to my kids. Did you know that the vast majority of kids sell the house within a very short period of time and take the money and split it up? They don't look at it as someplace they're going to move into. I mean, they've got their own house. And when you die and you're 90 or 85 or whatever, the kids are probably 50 and 60. I mean, if the kids don't have their own house by 50 or 60, maybe there's some other issues. So it probably makes a lot more sense to give them a Roth IRA or give them life insurance or give them one of your real estate investments. That makes a lot more sense than trying to give them a house, because now they got to prepare it for sale and, of course, clean it out and everything else, and then take that money and divvy it up. And it's not an immediate thing at all. And they got to pay while they're getting it fixed up. Very different when you do it with a reverse mortgage. There's still the excess equity still goes to the kids. But on the other side of the equation, you're in a situation where that money is much easier to divide up. And when you do the reverse mortgage, if I die and my house is worth $2 million and I owe $1 million, the kids get the other $1 million. So it's not like I'm giving my house away or giving up value. But here's the other thing that, Peggy mentioned that I just got back from Iceland. We do reverse mortgage vacations with our kids. So we give money to our kids early, and I don't have to pull it out of bucket 2, or I don't have to work harder to be able to take them because I'm not making mortgage payments. And so we have a standing offer in our family. We have 4 sons, and they're all married. Some of them have kids. And if they want to plan a vacation, the requirement is they have to take mom and dad along, and they have to plan it. They get my credit card. That's my contribution. And they can plan this whole vacation. One kid planned one to Kauai. Another one planned it to Cabo. Another one planned it to Europe. And the last one just planned it to Iceland. And I would rather make memories with those kids and have pictures of us hiking on a glacier, going down a waterfall in Hawaii, and being in a helicopter tour over Kauai, than saving all that money and giving them a house at the end. Now, a lot of people might not agree with me, but I can tell you it's really cool for our family. Why do we think we have to die to give money to our kids? It doesn't really make sense. You can give it to the kids now while I'm alive, and I can be more in control of those memories and helping them in different ways. I helped all of them buy their own houses, which have all went up in value. All of them are invested in real estate a little bit or a lot because I've taught them the value of that. So, Michael, you can drop that down if you wish. I'll just open for a minute questions, comments on that, and I'm going to get into the two major types of people that do reverse mortgages. But any questions on that?
I have a comment.
Please.
I like to start anyway. So your story about the lady who was basically broke and had a $5 million home and borrowed $2.5 million. So she went from broke to accredited investor. So she could then invest in anything she wanted because she had money, not her home, that over her $1 million of equity.
Exactly correct.
I thought that was fantastic, going from broke to accredited investor. And
in one day.
And yeah, in one day.
I mean, it was a month and a half worth of paperwork, but
on the day that she got the money, she became an accredited investor.
Yeah,
I don't know how long she had to wait. How long did she have to wait to get that $2.5 million?
She had the line of credit immediately in 3 days.
Okay, good. But she has to pull it out, doesn't she, to be an accredited investor?
Yes, but she can pull it out, put it back in, pull it out, put it back in, depending upon which option that she goes with. So it's a line, so it goes back and forth.
Yeah, you just have to show that you've got it.
Exactly correct. Yes. So
and then there's also rules about gifting. So you're talking about you your kids plan a vacation, you take them on vacation basically. But if you really wanted to gift money to your children or actually to anybody, there are rules that you can give so much every year that will reduce your equity, and they don't have to pay taxes on the gift. If anybody wants to look into that.
A lot of people are a little bit confused on that. I used to be, because I said, like, for example, right now in 2024, I think the number now has went up to 18,000 per kid. But if you have a husband and wife, the wife can give 18,000 and the husband can give 18,000. So really you're giving 36,000. And so, for example, let's say you're married and you got two married kids and two grandchildren. I could give up to 36,000 to each of the kids, the spouses, and the grandchildren without having to file a gift tax return. So that'd be 216,000 that I could give to each year to the kids without filing a gift tax return. But if I wanted to give them 500,000, I can do that. I just have to file a gift tax return. And as long as my combined gifting to them and inheritance is not over $7 million, which is changing, it'll probably be down to 5 million or whatever. In some states change it. But you're usually going to be somewhere, the lifetime sales estate tax right now is like 14 million. But in some states, you're talking 5 to 7 million. So as long as you're under that 5, 6, 7 million, or federal, you're under 12, 13 million, it doesn't matter. There's still no taxes due. So if you've got a huge estate that's over 10, 12 million, then get an estate attorney and plan things out. But just because you give them more than the $18,000 limit, that does not require them or you to pay any taxes. So thank you for bringing that up. It's a really big issue. So
anybody else have a question? Jonna?
Thank you. Harlan, why 62?
I should clarify that. Thank you for bringing that up. In some states, California and Washington, where Michael is, you can do it at 55 on a jumbo loan, on a non-FHA loan. Those don't have as much flexibility. It's not like they're a bad loan. They are higher interest rates and lower closing costs. But you can do those at 55. If you're over 62, the best deal, unless your house is over 1.5, 1.8 million, the best deal is an FHA loan because of the uniqueness of the attributes. And so you can't get an FHA reverse mortgage until 62. But if you're 55, then you should start taking a look at your options at 55.
Okay, so that's
know that.
yeah, and then I think reverse mortgages got a bad name because people took reverse mortgages and the market fell in 2002-8 and people were upside down and essentially either had to start making payments or walk away from their house. What protections are there now that you don't run into that in a market downturn?
Well, that's a really important point, Jonna. So the big thing to understand is there's two different types of mortgages. There's non-recourse mortgages, which is the only thing that movement makes available. Then there are recourse mortgages or recourse loans that are not really reverse mortgages. They are shared equity loans. Now that sounds nice, but beware. Sharing and equity are nice words. Sounds really nice. But they are dangerous because it means that you have given up part of the value of your house to an investor in exchange for a loan. So they have bribed you to give you some of their future equity in order to give you money today. Michael just dealt with one of these clients in a company called Unison, I think. There's several companies out there that do it. They're not reverse mortgage companies. They are investor companies. And Michael, I think in 3 or 4 years, didn't that client lose about $400,000 worth of equity? I mean, annualized, it was like they only got like 150 grand, and they ended up losing like 2 or 3 times that.
Right. Yeah, it was crazy to me. I've seen 2 of them recently where, they thought they were giving away 10% of their equity, and yet in 4 years' time, they'd given away over half. So crazy. And still had a mortgage payment.
Yeah, they're still making payments. So this is a shared equity loan, and that's where, Jonna, in a decreasing market environment, they can trigger a payment that now you have to pay, or the loan is due right now. You got to sell it right now. A non-recourse loan, the ones that Movement does, that Michael and I do, we have never done a shared equity loan and will not, unless the rules completely change and they're made for the consumer instead of for the investor. In our situation, it's non-recourse, so a loan can never be triggered. My uncle died in 2009 during the crash. He was upside down by over $50,000 on his little $100,000 house in Edgar, Wisconsin. First of all, as the value went down, nothing was ever triggered. That reverse mortgage stayed in place. And when he died and we sold the house, I was one of the executors, so I was personally involved in it. We sold the house on a short sale. His estate paid nothing. And the $300,000 that he had in a real estate investment, that was a good commercial real estate investment during that time period, sold for $300,000, and he never had to pay, the heirs never had to pay any of it back. So he was able to live in the house until he died, even though in a declining value environment. And in that 2009 situation, when he was upside down, the difference was paid for by FHA mortgage insurance. So it can never trigger the only thing that can trigger the loan to be called due is death, permanently moving out of the house, you move to a nursing home, or you don't pay your taxes, your real estate taxes. And you got to pay your taxes whether you have a mortgage or not, because you'll lose your house if you have your house paid off free and clear, and you don't pay your taxes. So pay your real estate taxes, live in the house, and you will never get kicked out of the house until you're 150 years old. My loan is due, says right in the mortgage documents that my loan is due on my 150th birthday. I'm going to have to make other arrangements if I'm still alive. I'm not too worried about it. That's 80 years away yet. So, but those other loans gave us a bad name. If you heard Bon Jovi's music, "You Give Love a Bad Name," those loans give us a bad name. because they kick old people out of the house. They take a lion's share of the kids' equity and they piss everybody off, and then we get the bad name out of it. Great
Okay.
question.
And then you said that it was easier to divide up when at death, right, in the settlement. Why is it easier to divide up a reverse mortgage than to sell the house? Don't you have to sell the house
Well, you
as
still have
well?
to sell the house, yes. Let me clarify that a little bit. It's easier to divide up cash. If you're dividing up a Roth IRA or a life insurance or any other investment, just divide it up 4 ways if you got 4 kids like I do, or 2 ways or whatever. But at the end, if you inherit a house that doesn't have a reverse mortgage on, you will continue to pay in on the payment or on the utilities, taxes, whatever. On the reverse mortgage is taking care of all of those things at closing. So you don't have to make a payment while you're waiting. The interest just continues to accrue, but it's not like you got to start putting a whole bunch of money in. If you have to put in maintenance costs, well, then you have to put that in, of course. But otherwise, it's much easier. All the taxes can be paid at closing. When you sell it down the road, it's a much simpler way for the kids to be involved. If it's upside down, it's really easy. You sign a paper and say, you guys can have it. And you don't even have to deal with it at all. But you may want to because you want a tax deduction and you want to control where the family home goes to, but you don't have to. So it's still necessary to deal with probate, and it doesn't bypass probate unless you've got a trust. And we're happy to work with the trust as well. But it is something that consistently we do a lot more guidance and working a lot more with the client, which makes it easier at the end.
All right, thank you.
Thank you. Ted, you had a question.
One somewhat serious one and a couple of fun ones. The serious one really is disregarding regulations in the circumstances. Why generally is a reverse mortgage not very helpful to somebody who is relatively young?
Well, I consider myself relatively young because I got my reverse mortgage at 62 as soon as I could. So I'm much younger than an 80-year-old, for example, or an 85-year-old or a 90-year-old. The earlier you do it, the more money you have to put into other places. If I wouldn't have started planning for this when I was in my 40s, I wouldn't have been able to put as much money into other investments if I would have been too busy paying off my house. I always paid the minimum. I always took cash out of my house when I refinanced. I have to be down below 50% equity when I get to 62, but I made sure that I was using the equity in my house. I was not burying it in the house. And so the earlier you do that, whether you're in your 40s or 50s, as you're planning for a reverse mortgage in your 60s, the more money you have to put into other places. I was able to buy an office building 15 years ago for $100,000, and I had to put a lot of work into it and put a lot of money into it. But now today it's worth $1 million. If I would have been too busy paying off my house, I wouldn't have been able to afford that real estate. I wouldn't have been able to put money into passive real estate investments over the years if I would have been paying off my house. So the earlier you implement the strategy and put it into your planning, even before you can do it, mathematically, the better off you'll be. If you pull the money out and buy fancy cars.
Okay, maybe what you were exchanging, let's say, mortgage or contributions to bucket 3 to put it into bucket 2.
Yes.
Okay. By the time I was your age, I'd had my house paid off for years, but so I didn't have let's say, that kind of choice to make at that point. But the observation that I made when I talked to reverse mortgage folks was that I couldn't get enough money out of the house at a younger age because the amount of time that the reverse mortgage conceivably would run would reduce the present value of the available investment down to a number that didn't really make any difference.
Well, it depends on how valuable your house is, but let's say that you're 62 and you qualify for 32% of your value, and you've got $1 million house for easy figuring, that's $320,000. If you,
90% of houses are not worth $1 million.
I understand that. I'm just using that as easy figuring. So if you got a $300,000 house, you only get 100 grand. If you've got a $200,000 house, you're only going to get 160, but whatever. I'm just using it for easy figuring because it's easily divisible.
Yeah.
So it is true that in $1 million house, you only get $320,000. However, and if you're 90, you're going to get 700,000. Well, the only thing is, in that 30-year period of time, you're far better off using $300,000, because that $300,000, when you have your house paid off, that $300,000 grows by 7% every year, or $100,000 grows, whatever. So if you have a $300,000 house and you pull out a $100,000 line of credit and you don't use it, that 7% allows you to pull out $7,000 a year to use. That costs you absolutely nothing on the line of credit. Your line of credit is still $100,000. And if you pull all that $100,000 out because you can earn 14, 15% somewhere else, well, then that's a smart thing too. Either way, it can either help you with income and allow you to take more of bucket two and do more investment. And small things grow. I mean, as right now we're putting seeds in the ground up here in Minnesota, and they don't look like much now, but in a few months they're going to be, peas and corn and pumpkins and all that sort of thing. So you've got to have some seed money. Buffett's right-hand man was just had said, Charlie Munger, before he passed, you start with $100,000, you can do some great things. You don't need $1 million to make more money. You start with 100, and 100 is a lot of money. So that's just, it just depends on what you want to accomplish. If you need 500,000 and we can only give you 100, well, that's not meeting your expectations. But what can you do with 100 then? Because if you wait until you're 90, we can give you, now we'll give you 220,000, but you don't have much time to enjoy it because you're already 90.
Okay. Another one that's, let's see, a little bit more fun to think about at any rate is what sort of question would you ask somebody to, let's say, to learn that they are not a very good candidate for retirement planning?
For retirement planning or for a reverse mortgage?
Retirement planning in general.
Well,
Michael did that sort of work, so you might want to weigh into it as well.
Well, there's three types of people out there. There's savers, and there's spenders, and then there's stupid people. And you can't help stupid, can't fix stupid. If somebody is just going to waste everything they have and make really stupid financial decisions and get divorced and not get anything from their exiting spouse, and they're going to just walk away from the marriage and not get half of his $600,000 IRA or 401k, you can't fix those things. And those people are a liability to us. Michael and I want to stay away from people who are stupid. Yeah. And I don't mean this because I don't like them. I like stupid people. I feel sorry for them, but I don't want to do business with them because those are the ones that usually sue you.
Well, my question would really amounted to, how do you identify this as your term, stupid people?
Well, all you have to do, I mean, we get a lot of information on people. We see their tax returns. We know how much money they lost in gambling. And we see their record that they didn't pay their JCPenney bill. And JCPenney, I don't know if they have credit cards anymore, but their Macy's bill, for the last, it was only a $30 payment, and they didn't pay it for they're 90 days late on it. And they don't have any good reason for it. It's not like they had a horrible medical thing or whatever. We learn a lot about people when we're asking for their loan documentation. And if somebody is going to be a waster, it's one thing to be a spender. Nothing wrong with being a spender. If somebody dies broke, that's okay. They had a good time. They were planning on it. They wanted to spend money. Nothing wrong with that. And people should not think that. But stupid people are people that are not doing all of the things that Peggy talked about in the thing that she read this morning. They're not paying attention to their money. They're not paying attention to their investments. They're living for the moment. They're blowing all their money. They're investing it wrong. They don't care about their kids. They don't care about their spouses. They're just plain being stupid people. And I don't mean that they don't have a low IQ. They're just being stupid with their money.
Now, here's the question that I suggest asking to identify the folks is, what fraction of your retirement income do you think should be provided by the government?
That's not
Well,
really pertinent to this conversation.
Yeah. Well, because if they expect all their money, their retirement income to come from the government, there's no point saving.
Well, they probably are stupid people, because if they want to rely on the government, you're probably right there. But the people in making that relative to what we're talking about, here's the deal: if you know that you need $3,000 a month to live in retirement, well, we know we're going to get $1,000, $1,200, whatever, from Social Security, and we know that we're going to get another $500 from an annuity that they bought years ago or whatever. Where do you make up the difference? Are they going to work at Home Depot, or are they going to do a reverse mortgage and take some money out of their house? We can look at that overall planning. What do they need to crack the nut in putting that together? That's really the scenario. And I see the slogan on your wall: you always pay for good accounting one way or another. Comes down to advice. I'm speaking to I much prefer a small group like this, but I'm speaking to 200 CPAs and financial advisors on Thursday in San Diego. And they're going to be really skeptical, and they're going to ask for some good accounting numbers and everything. And with advisors like Michael and myself, and good CPAs and good financial advisors working together, 3 doctors on one patient, things work out really well financially. And to continue on your question, if people say I can do it all myself, they're like my 4-year-old. I do it, Papa. I do it, Papa. Well, yeah, you can't do it all yourself. You need help. And then usually when she can't do it, she said, help me, Papa, help me, Papa. So we need to rely on good professionals and talk to people like Peggy, that are steeped in knowledge on, and real estate investing and those things that you're going to go into. Don't try to do it by yourself.
Yeah. And the third one, which is, I think, the fun question altogether, is, when is it okay for me to borrow money from you and not pay you back?
Well, that's the easy one. When it's a reverse mortgage, because if you got a regular mortgage, you got to pay us every month, and we are unyielding on that. You got to pay us.
So why does that? So why does that work?
Great question. A lot of people say, and we could say that Michael and I are really nice people, and we give you money and you don't have to pay us back, and we're just really nice guys. But we're for a for-profit company. We have to make money for our families. And it's important for us to be able to make money. It's important for Movement Mortgage to make money, or we don't exist anymore. And so the way that it works is these are zero coupon bonds, to get technical about it for a second. And a zero coupon bond is nothing more than a bond that you buy that pays you back a certain amount in the future. And so investors in Ginnie Mae buy Ginnie Mae bonds, LPL, any of the investment companies out there, Vanguard, Fidelity, they buy those bonds from us. And so if we give you $100,000, Ted, we get that $100,000 from Fidelity or LPL or whatever. They give us that money. And then they make the money on it in the future, and they pay us to originate that loan, because they're going to make money when you die 10, 20, 30 years into the future. And so they're guaranteed to make money on that. Zero coupon does not mean zero interest. It means zero payments. Thank you, Katiana. That's a very important scenario. So a zero coupon bond simply allows you to make zero payments now, and then there's a payment in the future. That is a very important thing. So this all goes around. If you've invested any money in a mutual fund, or if you have any bonds, you have some Ginnie Mae HMBSs, HECM mortgage-backed securities. So the reason that it works, because people say, how can you give away money and you don't have to pay it back? Well, you do. You pay it back in the future. The payments are just optional. I get a statement every month.
Here's the way I explain it. Because actually there's at least one more type of lending that I know of that also qualifies for this, and that's factoring. It's as long as there's more than two parties involved. Party A is making a promise to party B, party B makes a promise to party C makes a promise to party A. As long as each one of the parties keeps their promise, which they're supposed to, okay, then the original borrower does not pay directly the lender back, because the lender gets his money from another source. Works the same with factoring in that sense as well. So the idea is there needs to be more than two parties in the lending arrangement in order for it to work. In the case of reverse mortgage, the buyer of the house next is the one who essentially pays off the loan, or his banker in circumstances.
That's true.
Yeah.
As long as all the parties keep their promises, which is the way the design works, then it works. It's a three or more party transaction.
Yeah, the thing that everybody has to realize when in this situation, you're 100% right on that. But the reason that a reverse mortgage works so well is because FHA guarantees these loans, Federal Housing Administration. And so that is guaranteed that there is going to be a buyer in the end, no matter what happens.
That's protection for one of the parties not keeping his promise.
Well, it's actually a protection for all parties. That's the big thing.
That's the third party.
Yes, that is the third party.
That's the third party.
The mortgage insurance is actually a fourth party.
Well, yeah, FHA is, in my book, it's called the fairy godmother. The fourth party is FHA, and she comes in and waves the magic wand if the values of the house go down. And so we have a fairy godmother, which allows us to make promises that Michael and I could never make, even with the full strength of Movement Mortgage behind us, which is a multi-billion-dollar origination company. We could not make those promises because we don't know the value of real estate in the future. Insurance takes care of that. So
Okay.
If FHA has to step in, essentially all of us in the country wind up paying it through our taxes.
They've got that all worked out. It's all set up. So when you apply for your reverse mortgage, Ted, you will learn exactly how easily it works. So
in fact, it looks like you have gray hair, and you might want to talk to Michael.
Yeah. So David has asked a question, and
yes, David.
He wants to know about an investor stepping in when somebody actually moves out of their house and they're in a reverse mortgage. Is there any way for investors to take over this loan or put it in a trust? But that's
not really. The loan has to be paid off. The loan is due and payable, a DNP status, we call it. The loan is due and payable when the person permanently moves out of their house, and it has to be redeemed and paid for within a year. So if
have a year,
yes, there is a year after death. And so,
but if somebody just moves out of the house, so sorry, I jumped in on this. This strikes me because I'm an investor, right? So somebody moves out of the house, have a reverse mortgage. Now it has to be paid back, but I have a year as an investor. I could rent it out. I could do a lot of different things. My ultimate goal would be to, basically do a refinance, right? And get that put into a normal.
Yes.
How would that work? Let's say that the house, so we know that we know that FHA has a certain amount of, I want to get into this house for no money down. I don't mind paying the fees to do a refinance, but can I do it as a refinance, or
yes? So
have to do it as a sale? Does the owner have to do it as a sale?
Well, it depends on if it's going to the kids. If it goes to the kids,
no, it's an investor.
And so if it goes to an investor, and I mean, they have to get the approval of the kids, assuming that the person died. And so then the kids are sitting on this note that needs to be due, and the kids may say, "Hey, it's pretty close to the value. You just buy it for the note amount and we'll walk away. Just give, the house is probably worth $1 million, but give us 800,000 and we're fine. We just want to be done with it. We don't want to mess around with it for a year. We don't even want to clean it out. Clean it out for us, because they don't live in the area or whatever. So investors can and do. The other thing that investor can do, and that we let folks like is when my uncle died, and the house was only worth 100 grand and he owed 150. There was an investor that came along and bought the house for 95% of the appraised value, which was 95 grand. The house is now worth over 200, probably maybe close to 300. But back then in the crash in 2009, it was only worth 100 grand. And we could sell it for 95% of the appraised value because you didn't have to pay the amount of the loan back, because of the FHA insurance. And so that investor bought it for $95,000, fixed it up, replaced the red shag carpet and the green sinks and all that sort of thing, and made the house much more valuable. So investors that come in bad markets when real estate is decreasing, there's a lot of opportunities with reverse mortgages. So
right.
good.
But what
Good
if the
question,
person's
David.
still alive and just wants to like move into a senior living?
Oh, thank you for that. Yeah, the same thing applies. It doesn't matter whether you're alive or dead. If you want to sell the house for 95% of the appraised value, if it's upside down, you can walk away whenever you want. You do not have to pay the amount that's due. So
Is
if
there
I,
any way for, as an investor, is there anything I could do to just no, I don't want to have to pay so so as a buyer, you have to pay like 20 or 25% down payment if you're doing a buyout. Is there any
yes,
way just to do it as a refinance?
there is, but you're going to have to, I mean, we have deals that are on the forward side that Michael and I don't do, but our company does. That we have a lot of 5% down deals. We have a lot of investor loans that you don't have to put 20% down on, sometimes 10%, sometimes 15%, but there's almost always going to be money that's involved in putting into it at that point. So it's, unless you've got to deal with the kids as the heirs or something on that order, that would make a difference from that perspective.
So, yeah, thank you, Peggy. Harlan, thank you so much. To further my question, yes, it was for if somebody's wants to keep that in place and an investor help out in between, and they're going to move into a senior living facility and they like the income or share the income from it, if it's a rental property or whatever it is, what are the options from an investor standpoint if she does move out of the house?
Right. Well, let's say there's certainly creative things that can be done in that scenario. Let's say, for example, that the house is worth 500,000 and they owe 300. Excuse me. You could take over the house for 300,000 by refinancing it, and promise to pay them X amount of dollars in the future if they don't have any heirs and they don't really care about it from that perspective, and pay them some money out for a certain period of time. But then you're taking the risk of the future value of the house. It's in an area where you feel the value is going to go up, you're in great shape. If you feel the person is going to die pretty soon, you're in great shape. It's a little bit like buying life insurance policies, that that people are likely to die. There's a big market in that. And you could do the same thing. There's a very famous story in France about where reverse mortgages started 100 years ago, where an attorney did the first reverse mortgage that we know of, that had an older client who was in her 80s, who he thought was going to die soon. So he told her that he would pay her out, whatever the amount was, every month until she died. And when she died, he'd get her house. She outlived him. And it didn't work out very well. Yeah, he was in his 50s and he died at like 60, and she was still going strong at 90 something. So you have to be careful, because FHA mortgage insurance covers the whole universe. If you're doing it as an investor, I can give you a lot of information and numbers on it. You've got to know when that person is going to die, and you've got to know, or pretty close to when they're going to die, and you've got to know what's going to happen to the appreciating value of the house. It's a little bit risky on one house. So that's why these are pooled into the
Okay.
insurance thing.
So could you just go in and say to the, mortgage lender, because you're not going to use movement because they only do reverse, not forward, and say, this gal just wants me to do a refinance on the property.
Oh, movement will do it. We do the forward mortgages,
Okay. So
and
I just want to, she told me I could have it for the amount of the loan. So I just want to refinance the loan. Do I need to put any other money other than closing costs up?
usually not. It depends on the what the appraisal actually comes out to, that it's a real number, but
Okay.
that could certainly
Put
be
out for the
potentially done.
appraisal. All right,
Yep.
David, just
Assuming the appraisal is 500 and the lady wants to give it up for 300, that's certainly a possibility. But if you're agreeing to pay the lady out a certain amount to stay in a nursing home, you got to hope that she dies early.
well, or you put a renter in and she gets part of that income.
That's true. Yes,
That's how you pay her 200,000 or whatever.
that's correct. You just got to make sure that you've got the cash flow on the forward mortgage side.
See, David, the thing is, once they move out, the loan is due
Within a year.
it has to be paid off within a year after move out. If nobody else is living on the property that's related to the reverse mortgage signer.
All right, thank you.
Thank you, David.
Any questions? Because we're at past the top of the hour.
One of the things that I did not get into that takes another hour, so obviously we're not going to do it, but I want you to be aware there are several ways to save taxes with a reverse mortgage, both in using it to buy other investment real estate and in paying off an existing mortgage. So if Ted has his house paid off, he can't use that money as a deduction unless he pulls the money out and buys some real estate, which could then be used as some deductions on, because he's using the money for a business and he could write it off that way. If I'm paying off an existing mortgage, I've got $100,000 worth of interest by the end of this year that I'm going to pay off out of other taxable things, and I'm going to get a $100,000 write-off this year. That's another way to get a tax benefit. If you're doing a Roth IRA, there's a tax benefit there. So investing in real estate, paying off an existing mortgage, a whole bunch of tax things. I wrote some articles for NASDAQ.com that I can send to you, and I'd be happy. Let me see if it even.
Why don't you come back in a few weeks and have that?
I'd be happy to do that. We could just talk about taxes.
Yeah, let's do that. Let's just talk about taxes.
That might be a very, hey, look at that. Now it works when at the end.
Yeah,
this
because we're past our time, and so we need to be fair to everybody who's committed to the hour.
Yeah, I meant to do this earlier. If you want a copy of my book, you want to talk to Michael, just email me at harlan.accola@movement.com, and you can contact Michael, and I work together. We'll just get that information over to him from there. You can hit the QR code and you got the info. But if you want a copy of the book, I'd be happy to send it to you. Just give me your name and address, and we'll take it from there.
Okay, or you can email me and I'll send it on to them.
Good point. Yes.
Yep.
Thank you very much, Peggy. Really appreciate the opportunity to talk with all of you, and great questions. Michael, anything that I missed in the final words?
No, I think everything, it was a great presentation, and thanks for all your questions. And yeah, I think we covered it.
It was a great presentation. Thank you very much. Great questions, everyone. So thank you for that. And we're going to invite Michael back. Maybe he could come back in a week or two. Well, not next week. We have a speaker, but perhaps the week after that. We'll send you an invitation.
Yes, and we'll invite some of our real estate friends as well. And sorry for my attire. I'm traveling today, so I just got my hoodie on, but it is a movement hoodie. So I tried to be a little bit professional, but I don't look. I'll wear my collared shirt next time.
Okay. Thank you.
Thanks so much.
Bye, everyone.